Most welcome to Pro Accounting Academy. This is your CPA Ayman Kiwewa. In today's video, we are still continuing to look at consolidated financial statement. As I told you in the previous video, that we shall be going part by part. We complete all the parts, then after we combine those parts and we prepare a complete number about consolidated financial statement. And our yesterday we looked at when you look at this, we in the previous video I introduced to you the consolidated financial statement, this one, the consolidated financial statement, where we are going through different steps. And I believe those who watched the part 1 video, you must be okay now when it comes to determine the group structure and acquisition date. I told you we must start by determining the group structure and acquisition date. If you missed that video, go to part 1 of this, then you'll be able to watch step 1 and the sample examples we did. Now, we are going to go to step 2. Step 1, determine the group structure and acquisition date. Step 2, which is also very, very important here, is about our net summary, net asset summary. After determining group structure, knowing the percentage, knowing who is the parent, who is the subsidiary, who is an associate, we expect you to go to step 2 by trying to summarize or to make a summary of your net asset. Don't forget that net asset, our net asset, let me use this. When someone talks about net asset here, when we are to look about net asset, we all remember the accounting equation. I think we remember that our accounting equation, we remember this accounting equation was asset equals liabilities plus equity, or known as equity or capital. Now, if I'm to take this to get our net asset, or what you call it, we shall get our asset here, asset minus liabilities. What will remain with liabilities? What will remain with is our net asset, or okay, let me call it net asset or equity. Now, from our accounting equation, assets equals liabilities plus equity. So when we take these liabilities to this side, you can see that we shall remain with net asset, or what we call equity. So this one takes us to net what? Net asset. Meaning, when we talk about step 2 of our consolidated balance statement of financial position, we are going to look, when we talk of net asset, we are looking at the part of equity. In your income, in your balance sheet, there is equity section there. That's where we shall find net asset. Any component of our net asset, a component of equity. Component of equity here, you should think about components of equity. Think about things like share capital. Think about share premium. Think about maybe retained earnings. Etc. Any other component of equity. So when we talk about preparing or making net asset summary, so when we talk about net asset here, when I talk about our net asset, the net asset here, when I talk about determine the net asset summary, I'm referring to these components you are seeing here, the share capital, share premium, retained earning. So what does it communicate to you? When you're handling any number of consolidation, consolidated balance sheet, or consolidated statement of financial position, as you look step 2, you go to the balance sheet given. Remember, I told you they will give you balance sheet for parent company, for subsidiary, they can give for associate. You go under equity section. That's where you will find this part you are seeing here. That's where you will find this part you are seeing here, what we call net asset. Net asset under equity section. Equity section. Yeah. Remember, your balance sheet will have the assets, then you have equity and liabilities. So, yes, for equity section, and you find your components of net asset. Remember, I told you to get this component of net assets, of course, is total asset minus total liabilities. You may not do that in your exam. You just need to go to the income, to the balance sheet given to you for subsidiary or for associate. Remember, we are doing this adjustment for subsidiary or associate, or for the company you are acquiring. Yes, so there's no need why we should do this for a parent, because it's the parent or it's the acquiring company buying the other company. So we go, if you are working on subsidiary, we do this for subsidiary so that we can know the actual assets we are going to acquire or interest we are going to acquire in the other one, in the other company. This becomes very easy. If you are to go back on this, I am from telling you that we have already components of equity, share capital, share premium, retained earning. You should always look for such. For example, here, if you are to look at this, we have our share capital. This is share capital. We can use this. We have share capital. You would have to put under acquisition date and reporting date. The acquisition date and reporting date, unless they have told you otherwise. But in most cases, the share capital on reporting date will be the same share capital at acquisition date. Otherwise, what you have to do, go to the balance sheet given. We are going to have a look at an example. You pick the share capital of that company you have acquired. Could be subsidiaries or share capital for associate, depending on what you are handling. Then if you have share premium, still you bring it under here because this is also a component of equity. You bring it here. You get the one for acquisition date and the one at reporting. You record it there. You get the one for retained earnings. You also include it there at the acquisition date and at reporting date. But now, this one, I told you, for acquisition date and reporting date for share capital, it will be the same in most cases unless they have stated otherwise. The same applies for this, will be the same even this one. This the same even this one. But for retained earning, from the time you acquired this company, that is on acquisition date, they will give you this figure here. They will give you this figure. This one, you have to check in your question. At the date of acquisition, how much was the retained earning for the company you are acquiring? But for reporting date, you can check in your balance sheet given. You pick the retained earning from the balance sheet there under equity section. This is very important to organize your work. Remember, I told you presentation for this number is really very important. The moment you present very well, you will start collecting marks even before preparing the final solution for this number. So through steps, you will be collecting marks. Get retained earning from the question. They will give you, like, maybe at the time of acquisition, the ABC company had retained earning of this. Pick it from there. Then you record under acquisition date. Then for reporting date, you will pick from balance sheet. We shall see under equity section. Other components of equity could be the revaluation or any other component which may be mentioned. Still, you bring it there, even you bring here. Then here, fair value adjustment, I will talk about this. You may find that there are some items could be for liability or for equity, which were understated or which were overstated. We can make some adjustments and we incorporate in our net assets what? Summary. After that, you need to get your total, which total? Total at acquisition date and total at reporting date. Now, after that, we are going to subtract. We are going to subtract this total at reporting date minus total at acquisition date. When you subtract, you get a figure here. This figure, we call that post acquisition or post acquisition profit or movement. I prefer using profit because we are going to be using profit as we move on. Post acquisition profit. How do you get it? The total net asset at reporting date minus total asset at acquisition date. The difference you get, you will have what we call post acquisition profit or the movement. Then becomes very what? Very easy. This summary, please, you can take a note so that as you are handling your number for consolidation, after determining group structure, step 2 should be determining the net asset summary. And I have told you net asset summary, we get it from where? From our assets minus liabilities, then you remain with equity. Equity, that's the component. We are trying to adjust any component of equity, we adjust at this step. Let's try to take a look of an example here. Let's try to look at this example. When you look at this example, this example says, you look here, on January 1st, 2024, ABC Corporation acquired 60% of ordinary share capital of X, Y, and Z. Already at this step, you can tell that ABC is a parent and XYZ is a subsidiary. Why? Because ABC is acquiring more than 50%. When you look at this, it is acquiring 60%. From the previous step under group structure, I talked about that, I described that the moment you see that acquiring company is acquiring more than 50%, the acquiring company becomes a parent and the acquired one or the controlled company becomes the subsidiary. How would we know that? If the percentage acquired are more than 50%. For this case, we have 60%, meaning ABC is a parent and X, Y, and Z is a liability. All right. Now, they are giving even a balance sheet. This is what I was telling you. However, here, for learning purpose, I have not put a complete number of balance sheet, but rather I have just picked a section of equity here, a section of equity and liability, but I've picked a section of equity only. Remember, balance sheet is made up of assets, liabilities, and equity. I have picked on the section for equity because I told you when you are determining net asset summary, you only concentrate on the part for equity. Meaning, if your balance sheet, it's coming, your assets, liabilities, what you go to equity section, you identify. They are saying here the share capital was this was wrong. The share capital was 1,000 per share, no problem. But here for company ABC, this parent, this is parent. Don't forget this. This is parent, and this one is what? This is subsidiary. Now they are giving you the share capital for parent and share capital for subsidiary. For share capital for parent is this for 20,000. We don't need to do any adjustment. Our interest in this company, we are acquiring 60%. The one for is what 320. The share capital for share premium for parent is here. What about for subsidiary is here. The one for retained earning for parent, retained earning was this. This is at reporting date. Then retained earning for subsidiary is this one. Good. Now, Additional information. They are telling you ABC acquired shares in X, Y, and Z. When XYZ is retained earning, I told you they will give you the retained earning at the date of acquisition. When it stood, in other words, at the date of acquisition date, the retained earning was 100. You see, we have retained earning for X, Y, and Z. At reporting date, it was this one. I think you can see that retained earning was 344, but at the date of acquisition, it was 100, meaning this business was doing well. They made some profit from 100 to 344. Good. The question is, what's the question is determine. It's there. Determine. We're going to determine net asset summary. This is and post-acquisition profit for the subsidiary. I told you we do all these workings either for subsidiary, associate, then for subsidiary we incorporate or we add, we combine with those of the financials for parent to get what we call consolidated figures or financial information. Now, here we have to determine net asset summary. But don't forget, I told you it's better you use this table for net asset summary. It's a simple format. We shall have saying or step 2 net asset summary. And under net asset summary, I told you we can just summarize in a simple table. Can do, but for you have to be more organized than me. Yes, you draw a simple table here, and here you put details. Here you put at acquisition, date, then at reporting date. We have at acquisition and you have even at reporting. Now, you look here. We are taking the components of equity: share capital, share premium, retained earning, other components of equity. Now, the share capital, for this case, we are handling only we are taking these figures we are seeing here for our subsidiary. We shall handle this after. Now, the share capital, how much was this share capital? 320. You bring and you write your share capital. Share capital is at reporting and acquisition. They have not given us any information. The moment they don't talk any or they don't give any information at reporting, at acquisition, of course you maintain that 320. Then what else is given in the question? We have share premium, again 320. Share premium till 320. Even here 320. What else given the question? Retained earning. Good. Retained earnings. For retained earnings, You have 344 at reporting date. Yes, at reporting 344. 344, 44,000. What about at reporting date? I mean at acquisition. Here they are saying, you look at this. ABC acquired shares in XYZ. Here, I'm referring to this. ABC acquired shares in XYZ when XYZ retained earnings stood at 100,000, which means at the date of acquisition, the retained earning was 100,000. So you can take your 100,000 here. 100,000. 100,000. Then from there, since all components are finished, you can get total. Get simple. You can add with me there and you get the total. Yeah, you have 320, 320 plus 320 plus 100. Yes, you will get 740. 740,000. When you add this 320 plus 320 plus 344, 984,000. Correct. Now, I told you to get, post acquisition profit. Post acquisition profit. When you get this total net asset at reporting minus total assets at acquisition. When you subtract 984 minus 740, you'll get 244,000. The question was asking you to determine, it's very clear, determine the net asset summary and post-acquisition profit for the subsidiary. So our net asset summary is here given clearly, as you can see. This is our net asset summary, and our post-acquisition profit is given here. This post-acquisition profit, someone would be out there asking, why do we need even to determine post-acquisition profit? You have acquired this company today. Let me say, parent has acquired or has bought a company today. After acquisition, they start making profit. At the reporting date or at the end of the day, they have to share profit. Is this parent entitled for the profit which was made before it entered this group? No. It is only entitled for profit made after acquisition. That's why you have to determine it, so that as we are preparing our group retained earning, we shall take 60% of this 244. Why? Because we are controlling only 60%. So the moment we make 244,000, part of it will go to other shareholders, or we shall take to what we call NCI, and the 60% will go to the group. This step is really very important. You shouldn't jump this step as we move on. Having seen the step 1 for determining group structure and the acquisition date, step 2 determining the net asset summary, we can now go ahead to find out how much was this business acquired or bought. That takes us to step 3 for determining what we call the purchase consideration. This purchase consideration, we are looking at the money you paid when you are buying shares in the other company. If you are saying A, B, C company bought KK company, how much money did you pay to buy shares in the other company? So that's why here it is taking us to our consideration. We're saying purchase consideration. You look at this definition. Refers to the total amount of money or other asset. It can be money. You can money, form of cash or any other asset that a company pays to acquire another company, or it's what? It's shares. Yes. So how much are you paying? It's really very important as you are trying to make a consolidation. you are trying to combine your thing, you need to know how much money did I pay to buy shares in the other company. That takes us to purchase consideration. That's why we're saying refers to the total amount of money or other assets that a company pays to acquire another company or its shares. It represents the purchase what? Purchase price agreed upon. What you have agreed upon by the buyer and the seller for the acquisition. As you are consolidating, it's really very important. Some questions will be very direct. They will give you direct information. They can tell you KK paid cash of 1,000 US dollar or 10,000 US dollar. Some other question you may find they are giving you different what? Different parts. For example, here, if Sunrose Company buys shares in Sunflower Limited, the purchase consideration is the total amount Sunrose paid to acquire those shares. Hope it's very clear. The purchase consideration will be the amount you paid to acquire those shares. Purchase consideration can include the following. I said purchase consideration, the amount of money you pay to acquire interest in the other company or to buy shares in another company. But someone may think that it's only cash. No, we may have several consideration you may pay or things you may pay in exchange for shares in the other company. Yeah. Now let's start with item number 1. You may find in your exam, remember I told you this is part of a big number for consolidation, but the reason why it is still challenging so many people is because they fail to understand the basics behind that number. That's why I had to come in a different way to take you step by step so that we can master all these things. So for purchase consideration, as our step number 3, if they have given you cash, like that is the immediate payment made in cash to acquire shares or assets in another company. So if they say in the question, ABC company acquired maybe SC company or KK company and paid cash of 100,000, that becomes very direct. You don't need to do any calculation. You don't need to do anything. But sometimes you may find a question, more so those who are at advanced financial reporting, they may include several purchase consideration. Maybe you pay the cash and some other things. We need to bring them together and we get total. Now here, when you look at this, that is cash. Number 2 would be something else other than cash. That is share exchange, whereby you find instead of paying cash, you may make share exchange. They can give you a question whereby there is something like share exchange, and that's the consideration paid. You are exchanging shares, payment made by issuing your shares of to the acquiring company, or you are issuing the shares, your own shares, to the other company you're acquiring. Maybe your shares are heavy in terms of value than the company you're acquiring. Then you tell them, we are going to give you 2 shares, our shares, and we take 5 of yours. By doing that, you are trying to do exchange. Someone would ask, how can someone give you 10 shares and for you give him 2? Maybe yours are more valuable than the shares in the other company. Yours are heavy. That's why someone may decide to say, like I can give you an example. Think about this. When you have iPhone phone, just iPhone. These days they are common iPhone phone, and someone has other types I would want to mention here. And someone says, I'm going to give you one iPhone phone for you give me your 3 phones you have, which are not iPhone. You are exchanging. You are taking his 4 phones, and for you are giving him one. Instead of giving him cash, you are exchanging the phones. Here we don't exchange phones, but rather we exchange the shares, whereby I give you 2, you give me 10 or 5, depending on the agreement. So you may find the purchase consideration given in that question is not cash paid, but exchange of shares. Once that is given, we shall use the share exchange. We convert that into amount, then we use that as our purchase what? Consideration. It may not be share exchange and it may not be cash, but it can be the deferred payment. Deferred payment, we are looking at payment agreed to be made in the future. Yes, it can be cash, but to be made at a future date. Someone says, okay, I'm buying your shares, I'm buying shares in your company, or I'm taking 70%, but I don't have cash now. I'm going to pay you after 1 year, after 2 years. That is future payment. Where you find such, don't just add the future payment on cash, on a share exchange. You need to discount to the present value to reflect the time value of money. You must be knowing this, that of course the value of money today or the value of dollar today is not the value of dollar tomorrow. Whereby if someone is promising to pay you after 2 years and yet you are calculating today the value of that amount, it's better you discount by bringing it, getting future value to present value. That can help us to determine as well purchase consideration. So what I'm trying to show you here, I'm trying to show you that the purchase consideration may not mean only cash here. No, it may not mean cash. It may have cash as our number one. It may have share exchange. It may have deferred payment. It can have different form. You need to read your question given to you so that you are able to identify which type of consideration is given. The important thing here you need to know is about is about this. I'm saying, since it's not only cash, not share exchange or deferred consideration or any other, you have, in case you find a question where they have put like a 3, they may put like 3 or 4. Say paid cash of 10,000, also made share exchange of ABCD, also deferred consideration of this or payment. You need to add all of them together. However, don't forget this one I said, you are adding the present value, not future value. We shall discount. Where you find deferred consideration, it means in that question they have put for you some discount factors. You have to use, or the discount rate you have to use to convert future value to present value. Then after, you will be able to determine our total purchase consideration. This is the purchase consideration we are going to use even to other steps, like when we are determining goodwill, among others. So this is the actual amount of money which was paid for us to acquire shares in that company. All right, let's try to look at this example. I told you I brought for you different parts of our consolidation number. Then after, we shall do a complete question with all the parts. It is very important to first understand the part by part. Then after, if we are to do a complete number, it will be easy for us to identify the information given. This example you are seeing here, we are saying, and our example, ABC Limited is acquiring XYZ Limited. The agreed purchase consideration includes: 1, there is cash payment of 500,000. 2, there is issuance of 10,000 shares. 10,000, these are just shares, not money, but they are giving you the market value of this share, 50 per share. We shall just multiply. We shall get this. We multiply by number of shares to get the amount of money in those shares. Then even there is deferred payment to be paid after 1 year. And I told you they have to give the discount rate. Discount rate here given is 10%. Now, from there, they're asking you, calculate the total purchase consideration paid by this company to acquire shares in X, Y, and Z. Remember, I have already told you, they will not ask you this, but it will be part of what you are supposed to do. It will be part of the complete question of consolidation. So you must be able, they can just pick this and they put in a very big question, whereby you have to look for this information regarding payment made by the parent to acquire shares in the subsidiary. You can easily calculate. Let's try to do that. Let's try to do that. That is under our purchase consideration as our step number 3. Step number 3. Step 3, that is determining the purchase consideration. And under work purchase consideration, I told you number one here given, it is cash payment of 500,000. Number one, cash payment of 500,000. Number two, they are giving issuance. We shall make a share exchange of 10,000 shares with market price of market value of 50,000. So we shall get 50 times 10,000. So here it's going to be share exchange. It will be 10,000 times 50,000. And we get our 50 what? 50,000. That is 10,000 times 50, which is 500. Also, we shall have our 500,000. Good. And lastly, we have deferred payment, 200,000. Deferred payment. Now here at deferred payment, remember they have given us, you are expecting to pay 200,000 to be paid after 1 year. When you were to look at this, it is 200,000 to be paid after 1 year, and that annual rate of interest discount, the discount rate is the 10%. We are going to discount this 200,000 because this is future value to be paid in the future after 1 year. So we shall get that future value, we bring it to present value. So to get the present value, it is very simple. We shall just get this times the discount factor. And here we are going to have, we shall have, it is 200,000 times 1 over 1 plus, this is the formula for discount rate, times 10%. 10% power that 1 year. This one you'll get, okay, if I'm to bring it here as well, you'll get 200,000 times 0.09. Let me confirm here. It is 0.1, of course, 1 divided by 1.1. Yes, I'm right. It is 0.9090. Yes, all one, no problem. And here we shall get our answer as times 200,000 as 181,818. Now we have 3 purchase consideration. We have the purchase cash payment of 500,000, share exchange of 500,000, and you have deferred payment of 1.8. Then you can get your total here. Total purchase consideration is going to be, we shall add the other 1 million plus this 1 million plus 181,818. Of course, it is 1,001,818. This is going to be our purchase consideration we are going to use as you are handling the goodwill, if any. Now, purchase consideration, here you see they have here, this is our cash, which is this one. We have share exchange, and we have, so sometimes you may find a question where they have given you all the 3 or even more. But in most cases, they can give you cash. Cash is very common consideration paid when you're acquiring shares in another company. Can be cash, can be share exchange, can be deferred payment, can be any. Once you find them, please, you bring all of them, you add. For cash, you don't have to do any adjustment, just record it the way it is. For share exchange, just multiply the market value of each share times the shares exchanged to get this 500,000. Deferred payment, please, you try to discount. Here I'm trying to discount using 10% the rate given. Discount by getting the future value times the discount factor. And our discount factor, when I use this formula, comes to 0.09091. Total coming up to this. So when you add our three figures for cash payment, share exchange, and deferred payment, total, you will be able to get this as your purchase consideration. As we move on, we will be able to identify or to know that this purchase consideration is very important before even we add anything or we go into consolidated balance sheet, that format. It's really very important to go through all these steps. Let's try to go into step 1. Don't forget, step 1 was determining the group structure. Step 2, determining net asset summary. Step 3 is this purchase consideration. Now, let's head to step 4. Step 4. Step 4. Let's try to look at step 4. Step number 4 now. Let's try to go through step number 4. That is determining what? Determining goodwill. Now, let's try to go through this for goodwill here. You may ask yourself, why do we have even goodwill? What is goodwill? All that we need to understand at this point. Having seen the purchase consideration here done, let's try to go through the goodwill here. Goodwill, we are saying we are here. Goodwill is an asset. Where do you record assets? In our balance sheet. Where exactly? Under the current asset. That's where we put goodwill. So in case we find any goodwill, we shall have to record it there. But before we record it there, we need to know what is it and how does goodwill arise. So we are saying goodwill is an asset that arises. It arises upon the acquisition of a business and represents the future economic benefits from other assets acquired that are not individually identified and separately recognized. I'm going to give an example. For example, here, think about this. Remember, we are from learning or looking at our two things. That is net assets. Under step 2, we looked at cash consideration, or we looked at consideration. We call it, let me use the purchase consideration so that we can understand. Purchase. Let me do it from this side. Purchase consideration. Think about this. You have purchase consideration, that is from our step. Even I can use this one. Suppose it is 1 million, as we have calculated 1,181,000, and we have to pay this amount of money to acquire another business. Let me use that direct. Let me leave the words control or what have you. You have paid 1,181,818 to buy shares in another company. But when you go and you check on your net assets, remember our net asset? We calculated some net asset. Our net asset at acquisition here. Net asset at acquisition, this one. This net asset at acquisition. You realize the assets were worth 740. Just imagine, you go to buy asset in business on the net asset, they are 740, but you are required to pay 1 million. Let's take that. You were supposed to pay 1 million. Where? Here. net asset. But net asset, because this is what you are buying. Hey, you are paying for net asset, it was 740. Think about this. You got the business, when you calculate, you add all the assets, you subtract the liabilities, what remains as your net asset? Someone tells you, yes, can see they are worth 740,000, but the purchase consideration, all the cash, please, I need the cash. I need the cash of 1,181,818. So when you subtract here, you look at that. They are making you to pay more than the assets you are buying. Think about that. 1,181,818 minus 740,000, which is taking us to 418,18. Think about this. This takes us to what we call goodwill. We are saying the difference between the purchase consideration and net assets. Now you see the importance of our first two steps. Because if we did not have net asset, remember at step 2 we did net asset summary. That's where I have picked this 740. And step 3 I did purchase consideration. Meaning without step 2 and 3, you can't do step 4 for goodwill. Let's try to follow this. Now you are paying the net asset, you are paying for 740 items worth 740, but you are required to pay 1 million. The difference, that excess is for what? Let's go to our notes here. We are saying here that in summary here, goodwill is the amount paid in a business combination that exceeds the fair value of the identifiable net asset acquired. That's what I was talking about, that you have paid your net asset, or the net assets you are buying are worth 740, but you are required to pay 1 million. You see, that excess of the fair value of the identifiable net asset and the goodwill paid represent the future economic benefit from other assets that are not separable or individually recognized. Now we shall see which other assets you are not seeing, because we have calculated the furniture, the motor vehicles, the buildings, cash available. We subtract the liabilities, then we come up with the net asset. Of 7,440. But they're telling you, please, no, you have to pay 1,181. That difference of 441 represent other assets which are not separate or identifiable, or you can't see, but they are. You are likely to benefit from them. Think about brand name. You cannot see brand name, but rather you are going to use brand name to make for you money. Let's try to look at those items. Other assets. Keynote here. Goodwill is recognized only in a business combination. Yes, under IFRS 3. And when we are doing our consolidation, IFRS 3 and IFRS 10 are so important because they guide us on how we should handle. So IFRS 3 is used to show, we use it when we are handling the business combination, and that's where we shall find goodwill. Remember I said this business combination that arises as a result of purchase or acquisition of another company. Now as you are purchasing, you may pay more or a lot of money than the actual asset you are paying for. That's why you're saying it is recognized only under business combination. It reflects factors which other assets I was talking about could be factors like what? I'm talking about goodwill. When someone talks about goodwill, he may be referring to something like brand reputation. Maybe the reputation is too high and you will use it to make more money, to get more customer. Could be customer relationships, lists and other stuff. Intellectual property, could be other non-identifiable assets that contribute to the acquired business earning power. You see? So the other difference we are talking about, this difference here of 441,818 is representing other assets. Which other assets? Like here, the brand name, reputation, this intellectual property, among others. Those ones you can't see, you can't count, but this person who is selling part of his business or the entire business, for him he has in mind that I have brand name, I have brand, reputation, a customer relationship. All these I have to give you at a cost, which is the excess. And that excess between what you have paid to buy the other company and the actual assets you have counted, the difference is our goodwill. And this goodwill must be identified. We recognize it and we record in our balance sheet as we are reporting our consolidated statement of financial statement. Goodwill is measured at the excess of purchase price over fair value of identifiable assets and identifiable liabilities. That is our net what? Our net asset. That's why we are saying our goodwill here is purchase price, that is purchase consideration, minus net what? Minus net asset. That is purchase consideration, that is purchase price, this one, minus net asset, that is identifiable assets minus identifiable liabilities. Hope that is very clear. However, goodwill, though we have seen it is very clear, getting purchase consideration minus net identifiable assets, but we have methods we use when we are calculating our goodwill. Two methods. Let's try to go through very fast. Number one, here. Number one, two methods of calculating goodwill. In the examination, they will always tell you use method one or use method two. In the context of IFRS 3, we have primarily two methods used to calculate the goodwill during business combination. Number one, we have what we call full goodwill method, or what we call acquisition method or fair value method. The examiner may choose, please use, or the company has a policy of using full goodwill method or fair value method or acquisition method. Either way, we are going to see how we can handle that. The full goodwill method is accounting technique where the fair value of the entire group, we are looking at the fair value of the entire group, is used to determine goodwill. This method considers the total fair value of the acquired business, including the portion not owned by the acquirer. Remember, I said if you have acquired 60%, there is this 40% which is not owned by the acquirer or by the parent. This method says, please, we are going to consider the total fair value of, that is 100%, total fair value of the acquired business, such as for non-controlling interest, including the portion not owned by the acquirer, such as non-controlling interest, and subtract, we are going to subtract the fair value of identifiable net asset to arrive at the total goodwill attributable to the entire group. In other words, it recognizes full goodwill. We are going to see that the goodwill attributable to the entire business, that is for the group, not just the portion, regardless of ownership percentage. So whenever they tell you to use full goodwill, we are going to take 100% of amount paid, 100% of net asset. Remember, among those net assets, we have even part of the minority shareholders. But for this method, we shall take all the fair value of the identifiable assets. All right, let's try to look at this simple format. So here we shall have our goodwill will be purchase consideration, as I have told you, the money you paid, could be cash, could be share exchange. Then we subtract group share of net assets. We can separate, this is really very important, to separate the part that is attributable to the parent. Then we get the part attributable to NCI. Then after we add them. By getting purchase consideration, we less group share of net asset at acquisition. At acquisition, remember under our step 2, we had net asset at acquisition and net asset at reporting. Here we are using net asset at acquisition. You get your answer there. You go to fair value. This fair value of NCI at acquisition will be given to you in the exam. You check for it, it will be there. We less NCI's share of net asset at acquisition. Then we shall have our NCI. Now we have goodwill attributable to parent, goodwill attributable to NCI. But remember, this is full goodwill or total goodwill. What are we going to do? We are going to add. That is total goodwill. It is A. Suppose this is goodwill A. This is goodwill B. You add this goodwill plus this goodwill to get the goodwill to be recognized. Hope it's clear, and we need the student need an example, right? No problem. Note here, this note is really very important. Okay, here what I'm trying to refer to, sometime you may find in your question they have given you, after calculating goodwill, adding to get this total goodwill, you may have impairment loss that has resulted from your goodwill. They will be given goodwill impairment loss, maybe is this. Please you subtract, it reduces our amount for goodwill, and the remaining balance, this balance carried down, is the goodwill we shall be able to take to our balance sheet. Don't jump. I'm going to show you another way. Instead of using this way, I can give you another way of calculating this goodwill, and either way you will get the same what? You get the same answer. Note, goodwill impairment occurs. Goodwill impairment occurs. The entire amount of this, we say when it occurs, when you have that loss. If they tell you that there is goodwill impairment, the entire amount of the impairment loss is allocated between the goodwill and even NCI based on their relative interest. If parent is having 60% shares, then NCI 40, goodwill impairment, we shall share in regard to those percentages. For us to understand what I have explained, we need to look at this example. Let's take a look at this example briefly. On January 1st, 2024, Sunlaws Limited acquired, you see now this one, Sunlaws acquired 70% of the issued share capital of Sunflower. When you see 70%, this one, the one who acquiring company becomes the parent, and this one being controlled becomes what? Subsidiary. Subsidiary. For the purpose of preparing consolidated financial statements, the fair value of NCI has been estimated. I told you they will give you the fair value of NCI. Estimated at 2 million. The fair value of the net identifiable asset of this flat at acquisition, even they're giving you the net asset at acquisition, 3.2. The consideration transferred by Sunlaws Limited for its 70% shares was this. So they have given you the purchase consideration, they are giving you the net assets, the fair value of NCI. Now, from there, they're asking you, please, required, using the full goodwill method, calculate the amount of goodwill to be recognized in the consolidated balance sheet as January 1st. Show your calculation is clear. Then after, we shall try to use also this one, and we shall move on. All right. Now, for goodwill, given that example, the example we have for calculating goodwill, said you start with purchase consideration. Start with it is purchase consideration. Purchase consideration. And for purchase consideration here, it is given here the consideration transferred that qualifies to be our purchase. The consideration transferred by Sunlaws to acquire 70% interest was 3.5. 3.5. It is 3.5. Good. Less group share of net asset. Net asset at acquisition. And remember, the group share of net asset at acquisition, the group share of net asset at acquisition, we acquired 70%. We are taking 70% because it's saying Sunlaws Limited acquired 70%. But the net asset at acquisition are given here. Check here. The fair value of net asset at acquisition date was 3.2, and our percentage is 7. So we shall get 70% of 3.2. So 70% times 3.2. I wanted to change this color so that we can understand it. 3.2 is 70% times 3.2. What is 70% of 3.2? 0.7 times 3.2, which is 240. Hold on. Now, when we subtract, we shall get goodwill attributable to parent. So goodwill for parent is going to be 3.5 minus 240,000, and we shall get 1,260,000. Good. All right. Now, we need also to get goodwill attributable to NCI by getting the fair value. Let us assume this is our goodwill. This is our the goodwill attributable to parent. Then even you need to bring the fair value of NCI. You have to bring goodwill attributable to parent and goodwill attributable to NCI or other shareholders. So here you just jump like one line, and here you bring fair value of NCI at acquisition. Acquisition. How much was it? You got your question. You're saying when you check here, we are checking where when you go through this question, preparing the fair value of NCI, it's here, has been estimated to be 2 million. Yes, if it is 2 million, you take 2 million, your 2 million here, the 2 million here. 2 million. Still, we are going to less or subtract NCI's share of net asset at acquisition. Net asset at acquisition. Remember that this first share here was for group share of net asset at acquisition. Now this one down, you bring NCI's share, which is 30% of the same amount, 3.2 fair value of NCI at acquisition. Fair value, of net assets at acquisition. If the other one was 70%, automatically the NCI will be 30%. The balance is NCI. So we shall get our 0.3 times 3.2, which is 96. When you subtract this, we shall have our goodwill for NCI, attributable to NCI. Let me call this our B. It's going to be 2 million minus, which is 1,040,000. Now we have two goodwill. We have this goodwill A, which is attributable, this one, which is attributable to parent, and the one goodwill B. So total goodwill for this case, total goodwill will be A plus B. Goodwill A for parent and goodwill B to subsidiary. For A, it was 260,000 plus B, which is 1040,000. When you add to our two goodwill, what do you get? 1260 plus 1040,000. We shall get our goodwill as 2.3. And this is the goodwill. We shall take our balance sheet goodwill, call that goodwill carried down. This one. That's the goodwill we shall be able to take to our balance sheet. Now, when we were to look at this, our goodwill, we had to start with purchase consideration of 3.5. We less group share of net asset and acquisition. Then we get goodwill for parent. We get fair value of NCI at acquisition. Less NCI's share of net assets at acquisition. We get goodwill for attributable to NCI. Then we can get total goodwill, that is A plus B parent and NCI, to come up with goodwill. You may decide to present it in this way, or let me reduce for you. Someone else may decide to use another channel. You look at this. If you don't present your goodwill like that, you may choose to use this simple way or direct way, where we shall have purchase consideration. The purchase consideration you are seeing here, this, we may have a purchase consideration, this one. Then we less, here we have to add. We shall have to add here. Before we subtract, we have to add here fair value of NCI. NCI. You also add it there. Yes. So you get, we shall be able, you get purchase consideration, you bring it there. You add fair value of NCI at acquisition, you bring it there. Then you just subtract total net assets. Let's try to do that and see whether we get the same answer the other side. So here we are saying we can try or decide to use another way. Method 2. Here we can say all goodwill can be determined. We can start with purchase consideration. Purchase consideration. Purchase consideration here, it was how much? Purchase consideration was here. Purchase consideration 3,500,000. So you can bring that purchase consideration. This is another method if you are not familiar with it. 3.5. You can use this. Then you can add NCI at acquisition. And our NCI at acquisition, NCI, see here, fair value of NCI. It's given in the question here. I think I need to take it here so that you don't get confused. NCI, they are saying here the fair value of NCI here. The fair value of NCI has been estimated at 2 point. So we shall get this 2 million. We add our consideration paid. First add those ones. Then after we subtract this, add fair value of NCI to our purchase consideration. Then you subtract the net asset at acquisition. Only that you have done your goodwill using the follow method. Let's try to do that. So this one is fair value of NCI at acquisition is 2 million. Yes, you bring your 2 million, you put it there. 2 million. Sorry. 2 million. Let me put it here. 2 million. Good. Then From there, you can less or you can subtract total asset. This time we are not subtracting the percentage, we are subtracting total net asset at acquisition date. Acquisition date. And total net asset at acquisition date, already we have it here. We have been using, here we took 70%, here we took 30%. Now I don't need that percentage. I need the entire figure, this one. I need the entire figure. This, I'm not taking percentage, but I'm taking the entire figure if I'm to use the other method. Yes. So if I'm to use this method, let's try to check here. Total net asset at acquisition is 3.2. 3.2. 3.2. When you subtract, still you come up with your goodwill of when you add this, you get 2.3. Now we have two methods of calculating our goodwill. Method one is here, where you go through, you first get purchase consideration, less group share of net asset at acquisition, then you get goodwill for A or for parent. Then from there you bring fair value of NSI at acquisition, you this one. Then you can add the one for NSI to get A plus B, and you come up with your goodwill of 2.3. But this can be a longer channel for you or a longer way for you, and you choose not to go through this step. So what do? What you will do, you can use this short one. You see the short one is that's from there up to here. Only 3-4 steps and you'll be done with your solve. You look at this. We are looking. We have our goodwill. It is purchase consideration which will be given. Yes. You add net asset. I mean, fair value of NCI at acquisition. This is fair value of NCI at acquisition. Let me correct this. It is fair value of NCI at acquisition. Yes, you bring it here. You less total asset at acquisition. You remember that our net asset we calculated at step 2. You bring here and you subtract. Once you get purchase consideration plus net fair value of NCI at acquisition, you minus total net asset at acquisition, you will be able to get. When you look at this answer, this one, it is the same as 2,300,000. Even here we have this, the same answer, 2,300,000. Even here 2 million. When you look at these answers are the same. So you either use method 1, this method, you can use either method 1, this one, or you can use this one, or you can use this one. Either way, you will get the same the same answer. Doesn't matter where you pass, but as long as you reach and you are organized, you are presented in a normal way. Now you can visualize that each step takes to another step. Each step takes to another step. So you find step 1 takes you to step 2, step 2 takes you to step 3. Please, let's start by looking at our learning how to determine your group structure. That's where we started yesterday. The group structure as your step number 1. This one. Step number 1, determining the group structure. After that, let's try to see how we can get net asset summary as our step number 2. Step 3, let's try to determine what we call the purchase consideration, or the money you pay to acquire shares in another company. Then after having gotten that, you can proceed by determining the goodwill. For this video, I have given you only one method of calculating goodwill, that is full goodwill. Let's meet in another video where we shall look at other steps we go through as we are preparing the consolidated financial statement, and even we may have a hint on the purchase price allocation or partial goodwill method. As we go through other steps, just keep yourself with us. We shall take you through all you need to know, and you become a professional, you become a master, you become, an expert when it comes to consolidating any balance sheet number. Thank you. Keep yourself with Pro Accounting Academy. Don't skip any step. Follow the parts from part 1 of consolidation. Go to part 2, part 3, because I have developed this material in different steps. If you jump and go to step 3 or to part 3, you may not understand. Go back. Step 1 will take it to step 2. Step 2 takes it to step 3. Till when we shall reach a complete number about consolidation. And I believe we are learning something. If you have any question concerning consolidation, go into your comment section. You click your question there. Put your question, I will come and I respond immediately. Thank you so much. I remain CPA Ayman Kiwewa. We'll meet again in the next part of this video.